Welcome to the Asset Allocator podcast. I'm Simoney Kyriakou, editor of FT Advisor. This and future editions of the Asset Allocator podcast are going to be a little bit different, coming now to you in both audio and visual form. Just head over to ftadvisor.com/asset allocator to find out a little bit more. In this week's episode, we are going to be looking at why economists and investors have been reacting very differently to events in the Middle East. We're also going to be exploring why the persistently high gilt yields are having such an impact on your clients and their portfolios, and we're going to be questioning whether the AI trend, the mega trend of AI, can continue into 2026 and beyond. Well, joining me here in the studio today is Joe Little.
Hi, Simoney.
Hello. Joe Little is the Chief Strategist at HSBC Asset Management, and we're very pleased to have you with us.
Thanks a lot.
Thank you. Shall we get straight into it?
Sure.
So you have said that economists and investors seem to be reacting very differently or feeling very differently about the events in the Middle East, and they're perhaps operating in almost two different worlds right now. Could you explain why this is?
Right, so men are from Mars and women are from Venus. So it
Which
feels
one is which?
that way. Economists and maybe investors, as you say, in different worlds at this point in time. I mean, if you think about markets making new highs, a really rapid recovery following the geopolitical shock that we saw in late February and early March, real rapid recovery in markets, emerging markets performing very, very strongly as well across currencies and stocks and bonds. And then you reflect on the environment that economists are describing, who are very worried about the landscape. And it jars with that strength that we see in markets on low volatility. Because economists remain very concerned. Oil prices are obviously spiking. That has big consequences for how we think about growth and inflation. It's also been a historical trend that large spikes in oil prices have preceded recessions, economic downturns. We have inflation back on the scene. Central banks are thinking about hiking interest rates or maybe wondering if they need to hike interest rates. So the environment looks a lot more complicated from the perspective of economists. And then you end up with this tension.
Yes, of course.
High policy uncertainty, high geopolitical uncertainty, lots of things to worry on the economic front, but markets doing very well. Thank you very much.
Is that just a momentum thing?
Well, I think part of what's happened is that we've seen very, very strong news on profits. And that is, of course, concentrated in areas like technology, but not exclusively so. Materials, financials, and some spillover areas around the AI theme are also benefiting. But that strength in profits is really keeping the whole show on the road. So markets can be resilient to macro, political, geopolitical uncertainty as long as two things hold. Firstly, the profits growth remains intact. And as I say, it looks stellar so far. And secondly, if bond yields and the cost of capital can remain reasonably well behaved, so if we don't see the return of the bond vigilantes, which I know maybe you want to talk about shortly, then that keeps markets underpinned and in a positive supported place. It's that combination of strong profits growth, but the handbrake of higher bond yields not really acting as a drag on markets. And that's what we've seen so far. And so, as you say, you end up with this apparent paradox of markets hitting new highs, while headline writers at the FT and also economists are worrying a lot about all of the uncertainty that we see in the economic and political landscape today.
Can both sides be right?
Right. So that's exactly true. You can have a situation where macro uncertainty, policy uncertainty sustains, and yet markets climb the wall of worry. And in a way, that's what we saw last year. The Liberation Day tariffs, awful lot of uncertainty, question marks around how things would play out in terms of trade policy, where tariffs would finally settle. And what happened instead is markets climbed the wall of worry. Profits growth was showing strong momentum, strong performance, broadening out from just technology. And the Fed and other central banks were cutting rates, of course, which acts as a oxygenating factor for investment markets. So you had that tension all year, policy uncertainty but low volatility in markets.
Absolutely. And I guess everyone's right at some point with 2020 hindsight. Coming up on the podcast, uncertainty of gilt markets and the AI hype. Join us after this message.
Opportunity is everywhere. Access is everything. Access is expertise, guiding you with local insight. Access is discipline within a diversified approach, from traditional asset classes to ETFs and alternatives. Access is connection across a global footprint. Because when the world of opportunity is truly in reach, access is everything.
So, Joe, we touched earlier on the uncertainty of the gilt market, and who would have thought a decade ago that gilt yields would be higher than they've ever been since the Bank of England's independence? It's a very curious world we're operating in right now. Could you shed a bit of light on that?
Yeah, it's really captured everybody's attention. And wherever I go around the UK talking to professional investors, everybody wants to talk about this topic. So I'm glad you raised it. I mean, maybe three things behind the move that we've seen. Firstly, of course, we've had the energy shock.
Yes.
And that's really shifted the game in terms of how traders are thinking and economists are thinking about the short-term rate outlook. I mean, if you remember back to January, February, most analysts were expecting the Bank of England to be cutting rates this year.
That's right,
One or
yeah.
two cuts was the sort of consensus view. But that swung rapidly around, and investors are now anticipating 3 hikes from the Bank of England. Frankly, I'd be surprised if that gets delivered. But it reflects the challenging supply shock environment that we're in, with energy prices and commodity prices more generally spiking higher with the Middle East crisis.
So you're saying that's one part of the equation. I don't know how long the equation is here, but certainly there's also been a bit of a flight to safety.
Yeah. So, I mean, the second part of the way I would think about it is the reality of the UK at this juncture is that internationally it's seen as a bit of an inflation problem or inflation challenge. So we've been stuck in the UK at 3% inflation now. If you were coming from Mars to look at the economic data and the first thing you did is have a look at UK CPI and you're asked to guess what the inflation target was, you wouldn't guess 2%
No,
at this
you'd say
juncture.
about 3.
You'd say about 3. So it could be that 3 is the new 2.
Well, yeah, could it be?
Yeah, I mean, it certainly seems maybe for the UK, Australia, and to a certain extent the United States, although maybe the bond vigilantes aren't being quite as strict with the Treasury market as elsewhere. The reality is, you know, the UK maybe looks a little bit more inflation prone. I mean, to a degree, that's always been true. But of course, the debates that investors are having around the debt position, around UK productivity, around what might be happening in the political sphere, of course, don't help that discussion when we see higher inflation rates in the UK. And the third part of it is really quite interesting because we are riders on the storm in the UK bond market, and we are sensitive to what's going on elsewhere, particularly what's happening in the Treasury market. And of course, in the context of the Middle East crisis that we've seen, the inflation challenges globally that follow from that, at least in the shortish term, Treasury bond yields are rising as well. So part of the way to understand higher yields in the gilt market is connected to the rising yields that we're also seeing in the Treasury market. But gilts are rising a bit faster. So in bond investing, we sometimes say there's like a yield beta. There's a higher sensitivity in the gilt market to what's going on versus what we see elsewhere. And the rule of thumb has been that for every 10 basis points higher the Treasury yield moves, the gilt yield is moving higher about 15 basis points. So the bond vigilantes are here in the UK bond market. And maybe they're encouraged by the fact that we don't have a policy architecture which is suppressing bond yields, which is already something that's in play in Europe. The ECB used the transmission protection instrument to kind of keep yields capped across the Eurozone. So a couple of things around that shift in the rate environment, a sense that the UK has become a bit inflation prone, and the idea that maybe there's not quite the same coordination around policy measures. which are not adding a cap at the moment to gilt yields, have created a situation where gilt yields are now the highest they've been since Bank of England independence.
Mm-hmm. But it's not a problem in a way for investors because it gives institutional investors, discretionary fund managers, more tools to put into their portfolios. It gives sort of, the defined benefit pension schemes are all running excellent surpluses at the moment as a result. So for many people, it's a bit of a welcome relief, isn't it?
Well, a rising cost of capital is not great for growth, and it's
Sure.
not great for animal spirits or for economically sensitive asset markets. It's probably not great for stocks if it goes too far. But the good news is nobody really funds themselves off 30-year gilts.
Right.
So we're tending to fund ourselves shorter in the UK, looking at shorter term maturities in the curve. The question then is whether or not, if the Bank of England's delivering those hikes that the market is anticipated, and as I say, I'd be surprised, but if that does happen, then how do longer term gilts react? Do they rally? Inflation credibility is restored, or is there a spiraling challenge as those inflation questions become deeper and larger for investors? And maybe even a bigger concern about longer run inflation credibility resumes.
It's quite a blunt policy lever to pull.
Yeah, what I would say is that, I mean, in markets, of course, things will always surprise you. But one fact that we do see time and time again is that the best signal of future return in bond markets is when you have high levels of yields. And you have upward sloping yield curves. So the yield on a 30-year or a 10-year bond is higher than the 5-year or the 2-year bond yields. And both of those attributes are true in the UK today. So it could be that although a lot of anxiety around current headlines, a lot of challenges at the moment for the UK, if you've got a medium-term time horizon, it's quite an interesting opportunity to compound at almost 6% for ultra long-term gilts.
Well, let's go back to what you were saying about sort of the growth and look at AI. We saw in 2024, 23, 25, AI was doing extraordinarily well. Anything connecting to it, a company announcing that it had a new AI tool or developing new AI structures for people to pick up and buy, the momentum was incredible. But we've sort of seen that tail off a little bit in 2026. Do you think that we're still going to see a macro trend? Do you think the AI hype will continue? Or do you think that maybe we've just ridden that wave too much now?
Right. So, I mean, 2025 was really fascinating because AI was there, but there were other moving parts to the stock market as well. We called this a broadening out. There was a sense that the rising tide could lift all the boats. And that reflected a set of conditions in the global economy and in investment markets, which were really friendly to other parts of the market kind of catching up a little bit with AI or following the leader. Good global growth, benign inflation environment, rate cuts from central banks, weaker dollar. But since the start of the year, it's obviously been a little bit more tricky. We've got the return of geopolitics. We've got this big oil and commodity shock. So inflation worries are back to the fore. There is a challenge then around the growth outlook. The US is energy independent, but Europe, South Asia, Southeast Asia, big reliant energy importers. So a big challenge to GDP outlook in those economies. And as we've already mentioned, we've got the prospect of rate hikes. So it becomes a little bit of a challenge for thinking about how different equity sectors and parts of the stock market then behave, because investors are really looking for resilient and reliable growth. And part of the reason why we have seen a rapid recovery in stock markets since the Middle East crisis is really connected to a renewed belief again in the AI megatrend, exactly like you say. So the stock market rally has been quite narrow. There's a few leaders, but not many followers at this juncture. So a big question is whether this idea of the market continuing to perform, but performance broadening out across other sectors.
Right.
Is that something we can buy into again in 2026? Or is it just a 2025 story that's now kind of for the history books? And we kind of need to see that pattern of broadening in order to have a healthy bull market. That's the kind of healthy attribute that those bull markets are based on. So I think that's such a key question now, the extent to which the rally that we've seen can broaden.
Yeah, and the news can get obscured because, things like the commodity spike, gold and silver did so well January and February, and you sort of like the news almost gets drowned out, and then suddenly it's results season, and you're thinking, oh, wait a minute. Meta's going to be announcing its results, or Nvidia's going to be announcing its results. I almost forgot they existed because everyone's talking about gold or commodities or oil.
Everything, everywhere, all at once.
Yeah, quite a few film references.
That's how it's felt, right? Yeah, and it does feel like a dizzying experience for investors. I think that's how it feels in the trenches. I mean, it's clearly a different environment at this juncture versus what we saw during parts of 2025. But I think there are still reasons to be hopeful in terms of the market outlook at this point. As you mentioned, AI is performing. The multiple associated with the AI sector, though, is not so elevated at this point. It's rising, but is not so elevated at this point. So there's still maybe room for gains there. We've also got the AI sector maybe thinking about it more globally. So Korea and Taiwan have performed very, very strongly, but Asia technology is available as a way into the tech theme for investors at much lower multiples. And of course, emerging markets then not only have a tech angle to them, but also have a materials angle to them.
That's right.
With LATAM energy exporters as well. And that index is only trading on 12 times forward earnings. So if we can be comfortable with that sort of earnings prospect, then that's not such a high price to pay for a set of sectors that can still do well in this environment. Even in the US, we've seen an element in the recent profit season of industrials, banks, infrastructure, utilities, all showing signs of strong profits delivery for investors. So it's not quite true to say it's all about AI, but in phases it does feel a little bit like that. I mean, the one thing that we can also reflect on that might be a bit similar to last year is what happens with the dollar.
Right.
So that's a big part of the story for Europe, of course, but also in the emerging market space. The dollar can weaken. That does really help support the growth and the flow environment and investor sentiment across a whole host of emerging markets and rest of the world parts of the system. And one of the impressive features that we've seen since the start of the Middle East crisis has been how rapidly emerging market currencies have recovered versus the dollar. So maybe that's something to watch too. It can be a big source of support for global equities outside of the US.
Fantastic. Well, I'm sure we'll come on to emerging markets with you on a future edition of the Asset Allocator podcast.
Thanks a lot, Simoney.
Join us next week on Asset Allocator in either video or audio format. For now, thank you very much again to Joe for joining us, and thank you for watching us. Until next time, take care.